Let's be honest. When you hear Wall Street, you probably think of glass skyscrapers, high-frequency trading, and jargon designed to keep you out. And when you hear Main Street, you think of hard work, local businesses, and the actual economy we live in every day. For too long, there's been a massive gap between those two worlds. Welcome to the Main Street Meets Wall Street podcast. I'm Marcus, coming to you from Wall Street South. We launched this podcast and built this show on a very simple premise. I help Main Street meet Wall Street. We aren't here for get-rich-quick schemes. We're here to translate global market trends into local reality. We're covering the entire economy, from the Federal Reserve's latest moves to the heartbeat of the corner store. But I'm not doing this alone. We're bringing on the heavy hitters, industry experts and financial veterans who just aren't here to talk. They're there to break down the complex Wall Street jargon into Main Street English. And on the days when the news is moving fast or the topic needs a deep dive, I'll be going solo, stripping away the noise to give you a direct, no-nonsense look at exactly how the headlines impact your bottom line. We're living in a time of incredible change. The old rules are being rewritten, and the lines between the trading floor and the storefront is thinner than ever. We launched just a few days ago. Not too long, because this conversation needs to happen. You don't need a blazer and mahogany desk to build wealth and understand the world. You just need the right perspective and a seat at the table. So we built the table. If you know, you know. It's time to bridge the gap. Join me as I help Main Street meet Wall Street. Don't miss a single episode as we build this community from the ground up. Hit that follow button and subscribe to the Main Street Meets Wall Street podcast right now. Anywhere you get podcasts. Main Street Heart, Wall Street Smarts. Let's get to work.
It's the small things. So in Zen, they call it, I think it's Kaizen and Gaman. It's doing the small things and having the small victories, from when you wake up in the morning to what you wear in the morning to how you go about your business on a daily basis. It's those small things that build larger outcomes. And that is what I do on this daily basis. Hey, what are we doing today? Yes, we have a large gargantuan goal. We want to get to $100 million. How do we do that? That's fine. It's coming, but you got to do the small things. It's like eating an elephant, right? You got to take small chunks and you got to eat that elephant one bite at a time. You can't just say, I'm going to take the whole thing in. So it's the same thing with business, the same thing with sports, whether it's working out, what you put in your body. It's just the small things. They compound over a longer period of time. And hey, you end up having a good outcome, bad outcome, doesn't really matter, because the journey is the actual job.
Welcome back to the Main Street Meets Wall Street podcast with Marcus Sturdivant Sr. It's a YouTube channel. I'm Marcus Sturdivant Sr. You just saw the hook, the mindset of a man who played at the highest level in one of the most storied stadiums in sports history. But in part two, we're moving away from the Pinstripes and into the ledger. We're sitting back down with former New York Yankee Kevin Thompson, and we're getting into the mechanical reality of building a world-class financial firm. Kevin isn't just talking about wealth. He's an enrolled agent, deep in the trenches of tax strategy. Today we break down his blueprint, dominating the local market before going global, his current market insights, and the reality of transitioning into high-level financial planning. If you want to know how a pro athlete thinks about taxes and firm building in a $39 trillion debt environment, this is your masterclass. The ledger's open. Let's get to work. Just learning from experience, and you obviously have the proper mindset. That probably goes back to playing sports too as well. Like, swing it, you strike out, you can't remember that. You got to go back up to your next at bat,
1,000%, man. You got to keep grinding.
Yeah, you take, I'm not a baseball player, or never was, played some basketball, football, but I know, you got to let go of that stuff, especially in football. You can't hold on to that next play. You can you take parts and keys from it. You might take something from that pitcher, like what he got you with that pitch in life, and then you apply it so it doesn't happen next time. You store it back there, but yeah, you can't just let it derail you.
1,000%, my man.
In these let's talk about right now a little bit more into your firm and just in the market. Where are you seeing in the world and the market, and how are you working with your clients? We just went through a crazy time from February through right now. And we're recording at the end of April. This will probably be out beginning of May. And I'm sure there'll be more madness in between now and then.
Well, I was just on Yahoo a couple of days ago, and I was talking about this, about Back in the days, we could get 5.25% in easy money market cash and in treasuries. And it was like, oh my God, this is great. 2% real yields. This is amazing. And we could hang out there with in a risk-free environment like a couple years ago. And we would just sit there and be like, oh, this is just a phenomenal thing. And that allows us to get outsized returns in the fixed income space. So we would have a portfolio of fixed income. Let's just say it's 40%, a 60-40 portfolio, 40% being fixed income. We could use some of that 40% and allocate that to that safe asset. And then that produced a little bit more alpha for us. And we were outperforming the market for a while, like, because it was like, this is great. And now you have rates coming down. Now the fixed income portion was actually moving up as well. So we were really doing well. But now you're in an environment where we have headline inflation at 3.3%. They can lie to us all they want to about where inflation is. 3.5%. No, it's not. We live in the core environment. We live where there's food and there's energy. I don't give a damn where they live. We live in the real world. So 3.3% headline inflation. And then now you have yields that are 3.5 or 3.25 to possibly 3.8, 3.9% on the front end of the curve. You have money markets getting 3.5%. You're getting basically either flat to negative real yields in these asset classes. So what are people doing? They're taking that cash and they're dumping it into equities because they have no alternative. That's what you're seeing right now. That's why markets continually moving higher, because there is no alternative. I mean, equities have outpaced inflation over the longer term. So if you want to outpace that 3.3%, where do you have to go? Asset prices will have to inflate, and that's what you're seeing right now.
Gotcha. Yeah, and like you said, stocks, equities historically outperform inflation. Cash loses its value. I think I heard somewhere say the other day, like, inflation is eating up like 10 years worth of inflation, like the last 3 or 5 years. It's just been crazy how much inflation is eating up our actual purchasing power. So it's just like, so inside your portfolios, you're just saying, so you've gone from 60-40 to what, 70-30?
No. So what I've been doing, so the 60-40, which is of the 40% that I had that's fixed income, and a portion of that 40% we had like a cash bucket that was getting some outsized returns. So of that 40%, which is fixed income, we had probably a 10 to 15% sleeve that was actually cash and cash equivalents. So now we're getting out of that cash and cash equivalents and sprinkling that into more aggressive fixed income, like high yield and or some equity exposure. So when we talk about equity exposure and more risk, we're talking about high yield, possibly some preferreds, some corporate bonds that are getting a little bit of high yield, and then of course maybe sprinkling it into some equity exposure. So yeah, maybe it goes from 60-40 to say a 65-35 ish. But we're taking some of that cash and sprinkling it out on the risk curve. That's basically what we're saying.
Got you. Yeah, very interesting. So you're taking it and you're a little more risk on.
Yeah, a little bit more risk on. I mean, because you have to be. I mean, I'm not going to sit here now. I'm not saying that we're going to take their cash they're using for 6 months to 9 months or a year's worth of emergency. We're not taking that, but we're talking about just from a portfolio allocation. Yeah, we're taking that cash and putting it to work.
Yeah, I got you. I understand. Yeah. And then inside your actual portfolios right now. So I know for a while, when we had that mega bull run, I said 23, 24, 25, the American exceptionalism, air quotes, trade was working. But we saw in the last year that it diversified back out. We're kind of back into a cyclical rotation. Are you, and I had my clients aligned there for a while with that American exceptionalism trade. It worked. But then like at the beginning of last year, if you were still in that, you got your whole just entire face ripped off, pants pulled down, everything. You got exposed if you were in that too long. Are you more diversified outside the U.S.? As far as your equity portions?
Yes. So I typically have 15 to 25% in international at all times, especially last year when international just went gangbusters. I think our allocation may be up a little bit, possibly to 30%. I could pull that back, but at all times I like to have I keep it diversified across multiple asset classes. I don't overweight U.S. or underweight anything. I just keep it. Like, hey, if our portfolio is 70-30, of that 70% equity, we want to have a minimum of 15 to 25% inside of international, and then we'll diversify the rest, small cap, mid cap, large cap, etc. So yeah, I keep international exposure at all time, and a mixture of commodities as well.
What kind of commodities do you like?
It's just gold, and then of course silver. Just the typical stuff. I mean, nothing, not platinum, palladium, or anything like that. Just kind of gold and silver. Just keep it simple.
Yeah, I added some metals to our portfolios when gold broke. When was that? January, from its all-time highs. It's just interesting. Like you said, it's just a placeholder kind of. diversifier inside that
3 to
portfolio.
5%, 3 to 5%,
Right.
nothing more. Yeah.
Right. Nothing more. And then what are your takes on alternative asset, like the alternative asset allocators? How are you looking at those inside your portfolios?
I use mainly ETFs for that. I don't want to get into the try to picking and choosing. So if it's an alternative asset allocator, there's a couple of different options, especially in the ETF space. So I allow them to go in there and pick managers. And again, this is another 1 to 2%, 3% of the portfolio at all times. And again, I follow a lot of managers like BlackRock and State Street, so we'll monitor those. But typically, we just like to keep everything in an ETF wrapper because I don't want to be exposing my client to what we call idiosyncratic risk of just one single company or one single player.
Right. Exactly. So so if someone was wanting to come check out NY Capital, say they want to come work with you, what would that look like? Tell me a little bit about your process. Let's talk a little bit about.
So you want to know about my so I typically like to start with the taxes. I want to see exactly what's going on with someone's 1040. It's like doing an x-ray. Like I gotta let me x-ray, let me see if there's anything I can see, any issues we're gonna have to look at. Because I wholeheartedly believe that you can't do proper planning without looking at the x-ray. And you have so many advisors, and I was one of them, by the way. I was one of them. And I'm not saying you're wrong or anybody's wrong for doing it this way. But if you're looking to put something on someone's balance sheet, like an annuity or some life insurance or this or that or whatever it is, how can you do that without looking at an x-ray and seeing exactly what's going on in their financial life and what their taxes look like? You're just moving things in products. It doesn't make any sense. So I start with the taxes. I go back and I analyze them. We make sure that they're correct over the last 2 to 3 years, make sure there's not anything that we're missing. And then we can start saying, okay, it's in your tax return. This is what we see. And then we'll start putting that financial plan in order. But it has to start there, having that tax conversation. Like, hey, this is where we are. This is what we're expecting you to look like in the future. When you start getting Social Security and all the other things, and your distributions. I mean, if they're in the 30, say they're in the 30+% tax bracket now, right? Now you can make a recommendation on, okay, we're going to stay in the traditional space, right? We're going to stay deferring those taxes because we believe in the future when we start taking that income that we see right here, because you told us about your Social Security, you told us about your pensions, your tax bracket goes from 30-something% down to 24%. Now we can start doing Roth conversions then, and that's when we'll start looking at doing those things. That's the planning conversation outside of the estate, and especially when you have blended families these days. It's important to have that conversation because some may want some money to go to the one part of the family, the other money will go to the other part of the family. It's just the planning thing is pivotal, and having this conversation it just starts with the tax plan, goes to the estate plan, and then goes to the financial plan overall. That's just what I do. I'm not saying it's for everybody. And by the way, full financial planning is not for everyone because a lot of people just don't want to go that deep. Some people just say, I just want you to manage the money. That's fine. I don't necessarily prefer that, but I want to make sure that they know what we prefer.
Gotcha. Yeah. And I imagine even when you do financial planning or someone who just wants you to do the assets under management, just manage the money, you still have to know your clients. You still have to figure out this kind of stuff. You still ask for your 1040s in?
Yeah, I always ask for a 1040. Always ask for a 1040. That's the most important thing. That's the minimum thing I want to get. Here's the reality. Do you know how many P10s, and these are the people that can just do taxes and they'll submit the taxes, how often I find errors, and how often I say, hey, by the way, we have to go back in 2023, 2024, and 2022 to correct this error, because you have an error on 1 year, it's most likely this error multiple years, and now the client is owing taxes for 2 or 3 years. Now we got to figure out where we're going to pull that money from, right? And then we got to figure out what's the tax liability on that money. And yes, 100%, we got to look at the 1040. And if they don't get it to me, which is fine, but I'd rather have it than not. I can't do my best work without it.
Gotcha. Yeah.
And I'm talking about 1040. I'm talking about multiple years of 1040. I'm talking about 2022, 2023, because here's the error that I'm finding, quite frankly, is that there's either 8606 errors, which are basis errors with like, hey, we're taking basis out of your IRA when there's no basis at all. I mean, that was crazy. There shouldn't have been. That's an error. I'm finding errors from credits being given that shouldn't be given. And I'm like, what the hell? Where's this solar credit coming from? Oh, that shouldn't even be there, right? I'm finding errors on basis, and then just having the client know, hey, by the way, you're paying your tax professional like $2,000 for what? I don't even pay my tax professional that.
You call them out?
Yeah, I was like, yeah, I call them out, man, and I don't want to get anybody in trouble, so I'll just leave it. I'll leave it at that. Like
No, you're
we're having
good.
these conversations and these emails that go out. I'm very direct on these emails, and I'm a client advocate, man. I'm a fiduciary. This is where I'm at, and I'm on behalf of the client. And I'll tell them exactly what I'm feeling, and this is what I'm expecting, and I don't want to get anybody in trouble, but just make sure we get this resolved in a quick manner. That's not. I'm just very upfront.
Right. And people in our profession, they should respect that. Like, let's just, what are we talking about? What did I miss? What the people, they get in their feelings, and it's like, come on.
This one lady told me, like, doesn't he know that's a standard deduction? I said, that is not a standard deduction. I know what the hell a standard deduction is, and a credit is not a standard deduction. So stop. I said, just fix it. Yeah. It's crazy.
Yeah. They're not even taken from the same part on the return.
It was outrageous, man. And again, I'm not trying to get anybody in trouble. I just want to make sure that they understand.
Right. So when people come work with you, is tax planning part of your fee?
Yeah. So tax planning, tax prep is part of it's the tax prep is a separate entity. It's not consulting, but tax planning comes with the overall fee. So if we're doing investment management, then it comes with the overall fee. Now, our fee structure is basically we charge a one-time fee up front. And then if we get assets to come over, then that one-time fee is basically reduced and used in regards to the portfolio management. But yeah, we have a portfolio management fee, we have our one-time fee, and that one-time fee is for the actual financial planning side of things. So yeah, it's a good business, but we're serious about what we do for sure.
And then you do estate planning. So do you also do life and health if people need that as well?
Life. We don't do much health. I stay out of that world. I can't be the master of all things, and or was it called the something of all things?
Master of all trades, jack of all trades, master
jack
of
of all
none.
trades, master of none. Exactly, jack of all trades. And that's and I'm trying to stay away from way too much. But yeah, we have a life, and the reason I do life insurance because for me it's simple, and it's simple because if I already know the information, why do I need to go ahead and say, okay, let's give this information over to someone else and let them handle it? I'm like, well, it's a revenue stream for the business, which is it's not bad, but it also allows me to be, it takes out, and I know I probably shouldn't do it, and we can have a conversation about it, but it takes out just barriers for me just to say, let's just get this done. I need a term 20, call it a day, or I need a whole life 95, 99, whatever, call it a day. And we can get that stuff done. But most of the time it's just, I just want to make sure we get it. It's just streamline it and keep it simple. Cause I just, sometimes when you hand off clients, it becomes a bad experience.
Yeah. If I'm meeting with another professional in that sense way, I'm on to meet with the clients anyway. Yeah. Life and health, that's just something, the more things you can keep inside the plan, it's easier for you to have the actual plan. Cause sometimes clients will forget that what you're doing is an actual plan. So the investment part, even the investments they see in maybe that IRA account, that's just one part of the total portfolio that you have. We have something else that works this way, that works that way. Everything's not going to be up when everything's up. Everything's not going to be down. Everything's down. It's going to smooth this way and out to the right, up to the right. But no, that's very cool, very fascinating, the tax. And what got you started so deep on taxes?
The fact that every place you go as an individual is against it. And I mean, I'm talking about like, if you're working for an insurance broker dealer, we don't talk about taxes. If you're working for a regular traditional BD, like a FIDO or something like that, we don't talk about taxes. We don't want to talk about taxes. And I'm like, why do I want to talk about taxes? Well, there's a liability attached to it. But every client asks about taxes. Every one of them, like, hey, this is my taxes and tax. Do you do taxes? And I'm like, you know what? I need to know more about taxes. And that's what I wanted to do. And then I started realizing, like, oh my God, there's an entire world of knowing in this world. And it puts you as their advisor, as their trusted fiduciary. It's like, dude, I trust my guy. I have my clients that live next door to me that are my tax clients and my investment clients. And I had to fix their tax return for multiple years. And it's like, now it puts you in a whole different arena.
You said they're next door to you?
Oh, they live next door. Yeah. Right across the way. Yeah. And I'm going to say this before anybody. So if you aren't well known in your own neighborhood, you need to rethink your strategy, because many of us are trying to go global before we're even known across the street. You get what I'm saying? You start with the people in your current community, and then you branch out, versus I'm going to go on YouTube and I'm going to do all this stuff and everybody's going to see me. Your next door neighbor doesn't know your name. So that's a problem. Right?
Right. Yeah. I don't know if you ever seen the show Silicon Valley on HBO.
Oh my God.
Middle out compression. That's what you're talking about, though. That's what it is. Like you got to
Yeah.
start in the middle, and then like
Yeah.
it'll start. So it'll be self-sufficient once you get out. So you have seen the show. I can tell by your
Yeah,
those dudes are crazy.
it's funny. It's funny.
I
Man.
went to school with those dudes, not in real life, but all those characters. I definitely went to school with those dudes, those archetypal characters. But it's just, I digress, man. I digress. I'm sorry.
Yeah.
So we were talking about your taxes, how you help clients with taxes, estate planning, mindset. Now we're on to marketing. How did you grow your business? Like we were talking about, people need to know you in your community. Tell us a little bit about how you, because now, are you SEC registered?
Not yet. We're getting there right now. So this is my 3rd year of my RIA. We're at 53 million now. We're growing. We should be. I'm expecting to be at the end of the year next year at $100 million. That's just where our growth rate's showing us. It's really no magic bullet to this. It's about putting yourself in the right networks of people. It's about putting yourself in the right position to speak about what you're doing. And if you love what you do, you should tell people what it is that you do. And stop seeing yourself as just a financial advisor. I think what's his name? My man, what's his name? I can't figure. Anyways, my mind goes a bunch of different places. But
I know the feeling.
He was telling a story about how to interact with, tell your story, right? How someone tells your story. And give me 1 second. And what he said was, when someone asks you what you do, a lot of you might say like, oh, I'm a financial advisor, right? And that's not how you should approach this. He was saying that instead of saying that you're a financial advisor, you say, how, like you say, hey, so what is it that you do? I'm a nurse or whatever. Well, you know how when a nurse is looking for an opportunity to see exactly where she could put money away, or, what life looks like in regards to if something would have happened to her, or if something like you reframe the conversation to like, when a business owner is about to sell a business and is looking to see exactly what's the best opportunity for them to shield as much money away from taxes as they can. Well, I help business owners with that. It's just reframing the conversation. And that's what I think was powerful. That's one thing I've learned. And I can't believe I can't remember my man's name. I talk to him all the time. Holy smokes, is killing me. But I'll find it, man.
Are you talking about Michael Kitces?
No, it's not Michael Kitces. Oh my God.
Stan Morgan says that a lot too.
No, it's not Michael Kitces. But I will. I got to give my man some credit. I can't believe for the life of me that I don't know I don't have his name in my tip of my tongue right now. It's killing me.
No worries.
Go ahead.
You don't find him while we're on here. I'll put his name in the edit somewhere. So
no worries. No, it's killing me though. I'm like, my God, I know my man. He's been on a bunch of shows. Anyways, go ahead, man. It's all good.
You're good. Are you gonna be able to? You good?
Yeah, I'm good, man. I'm good. I'm great. I'm great. I'm all good.
I know how when something's in your mind and I
get it bugs the hell out of me. It does bug the hell out of me.
Yeah, you like trying to remember exactly.
Go ahead. So but I think it's powerful what that mode of thinking is. I think it's powerful.
We're partway through this conversation with Kevin Thompson. And if you're seeing value in this pinstripe discipline applied to your taxes and planning, you need to join the Main Street Meets Wall Street podcast or check us out on the Wall Street South Journal over on LinkedIn. Hit subscribe. If you're listening on the podcast, give us a 5-star review, download a couple episodes, and share with friends. Wall Street South Journal, we break down some of the issues hitting Main Street right now. Last issue was on broke. I've looked back at the 30 for 30 ESPN series of professional athletes. So click the link in the description box for the newsletter and get the logic behind what's being delivered to you. It'll come straight to your inbox. Now, we'll see if Kevin can remember this man's name, and we'll get back into the local marketing and his secret to how he grew. The secret to how he grew non-ACOP. Got you. And then you say you're in your 3rd year as fully independent. What?
Derek Kinney.
Yeah, I know. We're connecting on LinkedIn. He wears the loud coats and no pants. He shows himself in with no pants now, like shorts. Yeah, he's good. He's smart. He should come on the podcast if he ever wants to.
Mm-hmm.
Shout out. But shout out to him. Shout out to that train of thought. How did you individually, but when you started your firm, how did you get clients? How did you go from, I'm assuming you were working for one of the wirehouses, broker dealers, and then you broke off independent. You got some religion.
I was working for Park Avenue Securities, which is a Guardian life insurance broker dealer. And I decided this, 3 years ago. I said, you know what? I'm done. I need to go operate because I kept asking them, hey, can I do this? No. Hey, can I do that? No. And I was just tired of people telling me no. I said, well, the only way, if you're tired of people telling you no, go build your own thing, right? People want to complain all the time. So if you're tired of people telling you what you can't do, then go build something so where you can do it. And that's what I did. And I had a handful of clients that I left with, and they haven't looked back, man. I've also sourced 2 other advisors to come on board as well. So it's been slow. I mean, like, well, not as been slow. I started at roughly about 17 to 20 million, and that was 3 years ago. Now we're at 53. So I'm trying to get there as quickly as possible. Don't know why I'm running so fast, but I just think that for me, it's just a goal that I have, and this is where I'm at.
Your goal, you want to get to SEC 100?
Yeah, goal to get SEC registered as quickly as possible, and then really start focusing on adding new advisors, adding and branching out. That's the goal. And then we'll see how big this can get. I'm not trying to get 10 billion or anything like that, but we can see where it goes. We'll see.
Right. Like how many households do you currently hold?
Households, 94-ish.
Nice. Yeah. You want to grow to what, 300, 1,000? Do you know? Or you just, like you said, you're just running right now? Yeah.
Oh, we got 195, almost 200 accounts. 211 actually. I just did the ADV. 211 accounts. Yeah.
Gotcha.
Yeah.
Nice. So you're growing, and you still want like a lot more. You want to pretty much double that.
Yeah, I want to double it, but double it as in the type of clients we're getting. Like you can double your size, but have like I can get 30 new clients. Like the clients I'm working with now are going to be in the world with like, hey, 30 new clients will get me there. You know what I mean?
Right. You could double your clients and reduce your book. You could double your revenue and reduce your book.
Exactly.
Yeah. Exactly. That's what you're going for. You're going what, quote unquote upscale.
Yeah. Up market. That's it's been working because that's where we're at. Like most of my clients are $500,000 or more, $1 million or more. Yeah, that's where I'm at.
Yeah, and I know. I want to respect your time, so I don't want to hold you too long. What is an ideal client for you? Like, who do you work best with?
The majority of my clients are retirees, 65 and older, that are looking for distribution planning, looking for tax resources, looking for estate planning, looking for overall financial planning, so they can have all their stuff in one space. So if and when something were to happen to them, they have answers for their legacy holders. And then also knowing what life looks like if and when a long-term care event happens, if they have enough money for that. And then talk about distribution in the future from a tax perspective. When RMDs kick in, does that push them into a higher Medicare IRMA space? What does that look like? Should we start doing Roth conversions now where we're in the lower marginal tax rate, doing all of that? And then showing what the distribution plan looks like how much income do we have coming in? What does that look like moving forward? And how much are we currently spending every single day? And then what is that gap? If we're spending too much, we got to figure that out. If we're spending not enough, let's just spend more if we can. And if you're not spending more, where's that additional money going to go? So it's all of those things, but it's mainly for retirees. And of course, business professionals, a lot of people with 1099 income, a lot of people that are making, quite frankly, they're making $500,000 to $250,000 to $500,000, and they're just strictly 1099 and trying to figure out, okay, how do we set up our business? S corps, LLCs, bookkeeping, payroll. It gets real intense with that, but I do a lot of that as well.
Really, do all that on the back end for your business owners?
Yeah. Well, I don't. So
that's your other business.
Yeah, I have a CPA that helps do the bookkeeping and everything like that. We help them set up the payroll. I set up the solo Ks and everything like that so they can shield money away. And then we really have discussions about what is this looking for. Yeah, it's a lot of hand-holding in that, especially getting the LLC and everything set up and then showing them exactly why S Corp may be in their benefit and then how much we can save from a tax perspective, showing them the distributions and K1 distributions and where that money should go, making sure they're paying quarterly taxes. It's just, yeah, man. But we get paid well for it, but it's definitely a source that I do for a lot of my business owners.
Gotcha. Yeah, you say you get paid well, but you make those business owners a lot more money than you get. I understand that. Like that, business owners are saying that too. Business owners are great to work with, by the way.
Yeah. Well, yes and no, because they're always, you never can get a good time. It's like, I know we had 11 o'clock today, but man, guy, I can't do it today. It's going to be can we do 12 o'clock? I can't do 12 o'clock. I just got a new meeting that just popped in my books. Can we do, it's like, okay. So you're always on their schedule. You know what I mean?
But as far as like they understand the value of what you bring.
Yes, 100%.
They don't mind signing those checks. People don't sign checks anymore, but you know what I mean? They don't mind paying you for your
they
knowledge.
don't mind paying you. Like, here you go, man. 1,500, 2,000. Let's go. Let's get this done. I want to get this done. So yeah.
Right.
Yeah. We take money up front, and then we take money in the back end when everything's completed during the first year. So yeah.
So how's your payment structure?
So for a business owner, like we do about 3,000. So 3,000 is going to be 1,500 up front to get it started, and then when that's done, it's another 1,500 when the LLC and everything's all set up, and then we have this 401k set up. Possibly near the end of the year, they'll have to pay us another 1,500 to get that done. Now, depending on the complexity, it can go up from 3,000. It just depends on the complexity. But then, of course, you'll have my CPA. They'll do the bookkeeping and all the taxes. We want to make sure all the taxes and stuff are paid quarterly. We don't want to have any hiccups in regards to penalties and interest. So we got to make sure we got to get all that done. So we got to get everything up and running first, and then that's when I get my second payout on that.
Gotcha. Yeah.
And then, of course, in the solo K, we get the solo K set up, and then we'll start investment managing that. So that's another piece of the pie.
Yeah, you got to tell people when you're setting up a financial plan, like realistically, it's hard to enact a true financial plan in like a year. This takes time. Like
it takes time.
Plan, we're going to spend a lot of time setting this up and then building it.
But what pisses me off is that the compliance game, right? Like the compliance game, it's just like they want you to have something written down. They want you to have something that's in writing and have they sign. So what I'll do is to get the second payment from the financial planning perspective. Like it takes 6 to 8 weeks to get the whole plan. I'll get that done. Have them sign the e-money thing and say, here, just sign this so we can finalize this. And then we're gonna continue to have conversations. This is just strictly for compliance purposes. So when the guy comes in my office, he can see that I completed something. It's dumb to me. It's really stupid, but it's what they want, so that's what we give them.
Yeah, hopefully one day they'll realize that they should make life easier for advisors to work with their clients, right?
Yeah, it's crazy, man. It's crazy, man. But hey, again, this is awesome, man. What else you got for me?
What else do I have for you? I got plenty more.
No, I got a couple more minutes. I want to make sure I'm focused for you. I'm focused for you. I got a couple more minutes.
Got you. A couple more minutes. Okay, so we only got a couple more minutes, I guess. One thing, I'm going to ask you a couple more questions. One thing I know that we saw staying in the vein of LinkedIn, and we're talking about taxes, and when people come into you see a lot of crazy stuff on LinkedIn that people just talk about for people to do with taxes. I saw a post the other day. I can't remember who posted it. And it was so interesting that when I looked at it, I had to read it again because I was like, I would never do this. It was someone talking about like a Roth conversion, how you can do it you take $2 million and do the conversion and you end up with no tax bill, but what you're doing is they're planning on losing like $600,000 in investments to cover this tax bill. Like, how are you, when your clients come to you with this madness that they see? I'm sorry to any of my clients, anyone who might come to you with something that's, and I hate to say it's madness, but something that's outside the realm. To us, we're just like, come on. But to anyone else that might see this stuff, how do you approach that with your clients?
So I hear what that person's saying. I didn't read the post. So they're basically saying there's a loss on one side of the business. There's a loss somewhere, possibly a business loss.
They're planning in the loss in their investments. They're like, every year in my investments, I'm going to lose tax harvest loss, right? In your investments.
Tax harvest loss. Okay.
I'm going to lose so much money in my investments.
Okay. And then they're going to take a...
That was the big part, was the whole tax harvest. I was like, why would you plan?
So here's the deal with that. Even if you harvest a loss of, say, $60,000. Let's say I have a $60,000 loss. You can only take up to $3,000 in regards to carryover. So $3,000 standard loss. Boom. The Roth conversion is not a capital gain. So even when you Roth convert, that is income, ordinary income, that goes back to your taxes, that goes back to your 1040, your personal tax return. So let's just say you were at $100,000 and you did a $40,000 Roth conversion. Now you have $140,000 of income. So even if you took $60,000 of losses on one side of the fence in regard to tax loss harvesting, you can only take $3,000 of that maximum. Now, if they're talking about losses in regards to a business loss, that's a different story. But if you're talking about capital gains, you can only take $3,000 to offset capital gains, unless you have $60,000 of capital gains versus capital losses to offset that. So I didn't read it, and that doesn't sound right. But what it sounds like to me is they're talking about business, and they're trying to take a business loss somewhere to cover that. Which again, You possibly could, but it's more than
That actually sounds like it ties back to the 1.3b,
that.
right? That's where it's in there, right? Where that would be something
Yeah,
that you
you
guys
can take business losses. Well, technically,
expenses, maybe more with the expensive types. I don't
yeah,
know.
yeah, expense and all that stuff. But all I'm saying is that be careful what you hear on LinkedIn. Real, I get real upset when I see things, and I start typing in real big letters real fast. And I say, you know what? I'm gonna back off a little bit today because And what I started doing instead of having those guys, and the guys, like I did when I read a book, I'll put it out on LinkedIn, and I did the Discourse of Colonization by Sndyer. I wrote about it, and then the same typical guys come in. You don't know what's going on, and all. I'm like, hey man, and I always say that. I said, this is not unexpected coming from you. I get it. Trust me. Matter of fact, I would be upset if it didn't come from you, to be honest with you. I'm like, where's my man at? Right. But you got to know that there's going to be some people that are just going to throw some stuff out there. And I've started using the unfollow button, quite frankly. I'm like, I don't want to hear this guy's voice anymore. And I just,
Really?
Yeah. I don't. I stopped arguing. I stopped saying, you know what's the point? I just unfollow. I don't want to hear it. Because somebody a couple of days ago put something out about women and all this other stuff. And this one guy gets on there and this guy says, oh, you think this is bad? You haven't been to Iran. And I'm like, oh, you know what, dog? You're done, dog. You're done. I'm done with you.
So I said, like, LinkedIn isn't Facebook. Come on with
I
that.
said, I ain't got time for this, dude.
Yeah, LinkedIn's not Facebook.
Exactly.
Kevin, I really enjoy you hopping on in your time. If there's anything else you want to leave with Main Street, take a couple seconds or minutes, however long you want to take, give them a little bit, maybe some actionable steps they can take, and then let people know where they can find you.
Man, it's just one thing I'll say is this. In business and in life, we typically want to emulate people, and emulation is good, but be careful who you mimic, because in our culture here in the United States, we have a tendency to give the horn to people that have financial success. Financial success does not mean they are a successful individual or a successful human. Just because someone, quite frankly, a PayPal member, PayPal mafia guys, somehow lucked into winning a lottery ticket, now they have the bullhorn and everything is gold from them. Everything is gold from these guys because they have the wealth and they're on this pedestal. We have to stop that, because just because you have wealth doesn't make you a good individual, doesn't make you a smart individual. It just means either A, you got lucky, or A, you're good at making more money. And if that's what you value, I get it. But for many of us, if we call ourselves who we want to call us in regards to whatever you want to call yourself, I don't think that's where our mind should be. I think we need to be focused on this, being a good human and being there for other individuals to help them grow as well. Because if you help others grow, my man, you're going to grow, and it's going to be exponential. So that's my take. Stop allowing these guys to push you in these different arenas, and just be happy. Slow growth is the best growth, and it's there for a reason.
Very good, man.
By the way, you can subscribe to the 9 Innings podcast on my YouTube station, and follow us on LinkedIn at Kevin Thompson, CFP, RICP. And then also go to my Substack, Now What Substack, 9iCap. And then, of course, anything on I'm not on Twitter much and all the other stuff, but Threads, Twitter, all the other stuff is at MLB to CFP or at 9iCap. Just go and follow us. We have a lot to say, and I don't hold back.
Boom, there you go. Yeah, I was going to say, where can they find you? You forgot that part. And I see, like, you're in Newsweek a lot. Is that like weekly, monthly? You're just in Newsweek.
So I get these articles, and these people send me stuff every day. And I just I may respond to this. I may respond to this, whether it's Newsweek or whatever magazine. I just respond with my stuff. Either they'll use it or they won't. And I'm just like, okay, whatever. So it's good. I mean, it's a good problem to have, right?
I know the problem you mean. I know the problem you mean. Sometimes you're like, I'm only going to do this on a certain time, certain day. But yeah, I really appreciate you coming on. Don't want to disrespect your time. You have an open invitation. Let me know when you want to come back, and we'll hop back on.
Hey, enjoy Charlotte, my man. I appreciate you. Thank you so much for having me.
Thanks. Appreciate you, Kevin.
All right, boss. Talk to you later.
We covered a lot of ground today, from the discipline of the Bronx to the precision of the tax code. Kevin Thompson is proof that whether you're facing a 100-mile-an-hour fastball or a $39 trillion debt cycle, The solution is the same. Systematic execution. You got to eat the elephant one bite at a time. We talked about building a firm from the ground up while being an enrolled agent, and he's also a CFP and other fancy letters, is the ultimate protection tool. And while you have to win your home games before you can go on the world stage. Now, if this conversation helps you sharpen your own roster, do 3 things. Audit your tax shield. As Kevin said, if you aren't planning for the friction, you're paying for it. Subscribe. Join us here on YouTube or LinkedIn. We both have YouTube and LinkedIn channels. Or check out the Main Street Meets Wall Street podcast, the Wall Street South Journal. And then 3, share. Send this to one builder who is trying to scale either their local business or their micro business, your family. We're up here in Charlotte or down here in the South, Wall Street of the South. The ledger never sleeps. I'm Sturdivant Sr. Just hoping that I can help you bring Main Street heart to meet some Wall Street smarts. We'll see you next time with David Sndyer, the man who called the market bottom and is now calling for an AI bubble.
Looking at the circular flow of capital today, where big tech is essentially funding its own AI revenue, is the SaaS apocalypse we just saw in February the final warning sign, or is it just the first domino in a much larger systematic collapse?
Well, I really think the market is way overdone how much old tech is going to be affected by AI. The similarities are so strong with the late 1990s with the internet. Back then we had almost every industry was going to be disrupted and made obsolete by the internet, whether it was real estate, distribution, financial. All the financial firms are going to lose out to internet trading. Back in the late 1990s, a lot of those industries that people thought were going to be disrupted actually ended up surviving and doing very well. And the returns from March of 2000 for the next 10 to 15 years actually were very strong for a lot of those groups.